We've got Jamie Brito, Executive Director, Refining and Oil Markets at Opus Dow Jones. Jamie, appreciate your time on a day like today. And I want to go back to when the Ukraine war happened. We saw oil at $120. It hit about $120 a barrel. Now some are calling for possibly $100 oil. But for you, Jamie, how high can this go?
Well, it depends upon the time of the marine transit being interrupted in the Strait of Hormuz, of course. If you have 22 million barrels of crude circulating for this strait, and if President Trump said a few hours ago that this operation could take maybe around 4 weeks, then we're talking about significant implications in the overall global balance of crude oil. And then potentially prices of Brent could surpass the $100 mark. But as of today, the price is reflecting the startup of the operation, is reflecting the fact that there's no significant damage to fields, ports, facilities, and is betting on a potential solution maybe in the short term, in the next few days. But if it lingers more than a week, then we're going to have prices going beyond $90 per barrel for sure.
All right. And so a lot of this, of course, depends on how the geopolitical situation evolves. But in the past few years, we've seen oil markets spike on the back of disruptions or geopolitical tensions in the Middle East while pulling back down soon after. So let's say in the Gaza war, even last year's attack on Iran. So how sticky do you think these price rises will be?
Particularly after the Ukrainian-Russian invasion of 2022, crude prices have been relatively numb, relatively stable, because interest rates increased significantly. So there was kind of a price for financial participants that typically would pour their money into crude futures contracts, and they changed their strategy and put money into carry trade and other financial instruments that will give them more return. This is why crude prices were not responding with the same volatility of prior to the pandemic. Specifically, the $128 per barrel of Brent during the Russian invasion of Ukraine took place because there were financial sanctions imposed to Russian purchasing of energy from the European countries that immediately cut those 6-7 million barrels per day of hydrocarbons that Russia was exporting to Europe. So there was a supply shock. It will be not comparable to this shock today because we need to see the increments of Hormuz transit being stopped during the days to come. But certainly, if this lingers for a week or two, we will see gradual increase on Brent prices for sure.
Yeah, and you mentioned Strait of Hormuz right now. I mean, a lot of ships don't want to pass through that. What will it take for vessels to pass through that strait again? And when will this be kind of a logistical issue versus a price problem?
Well, for insurance purposes, for safety protocols, companies, shippers give instructions to their crew to turn around, to halt, their advance towards the strait. For those ships that were already in the Persian Gulf, they need to stay put close to Kuwait or as far away as possible from the strait. So I think in the next few days, it will be a matter of seeing a decline of missile strikes in between Israel, Iran, U.S. bases. And as long as you don't see this reduction or stoppage of such attacks, I don't see marine transit reconvening again, recovering their activity in the next few days, until you don't see a complete either resolution or a peace declaration from either side. Because if you see instability and any possibility that there can be any missile attacks in the region, not only is the Strait of Hormuz, but the entire Saudi Arabian peninsula that goes all the way towards the Suez Canal, the Bab el-Mandeb Strait as well. No ship can get closer to that because missile ranges capabilities can go all the way to the Suez Canal as well.
Mm-hmm. Yeah, I want to talk about the impact on Asia because China is a big customer of Iranian oil. And it's not just oil, gas as well. Asian buyers take about a quarter of their LNG from Qatar. So how damaging is this for Asian customers, India, China, and the rest of the region?
is extremely significant damage because in general, there's like 25% dependence, for instance, of Chinese total LNG imports from countries like Qatar. And there's really no substitution for this volume. You could argue that you can get a little bit more incremental marginal volume from locations like Australia or the US potentially, but they don't have the capabilities to supply 30% of China's LNG needs. So in the short term, the Hormuz Strait represents 25% of total crude oil demand, around 23 to 24% of total LNG trade, and around 31% of propane, LPG, and naphtha, which are feedstocks for the chemical industry. So there's no other choke point in the world that has such importance that the Strait of Hormuz. And if there's continuous instability, there's going to be an impact on all of these different supply chains necessarily over the next week.
Yeah, we'll be watching the supply chain after this, Jamie. Really appreciate your insights today. Jamie Brito there, Executive Director, Refining and Oil Markets at Orbis Dow Jones.